For a new real estate investor, what is the most significant tax advantage or pitfall, let's say, associated with choosing between a simple LLC and an S Corp?
Now, a lot of times people come to me and they say, hey, I've got an LLC. How much do you charge to do my tax return and what can we do? Now, a lot of people don't realize that an LLC is actually, in the eyes of the law, it's a legal entity that limits the liability, limited liability corporation. But in reality, it's not a real person. Well, why is this important? Because it can impact us on our pocketbook, our bank accounts. So the LLC itself does not have any tax filing status. They actually make tax elections. And there are 4 different ways an LLC could be taxed. One is as a disregarded entity where you just file a Schedule C as if you were a sole proprietor in your tax return. Another one could be a partnership, usually if there's more than one owner. Another way could be as a C corporation, and another one could be as an S corporation. So those are tax elections for an LLC, has the flexibility to choose which way it's going to be taxed. So an LLC is a good way to start your business because it gives you the opportunity to choose different tax elections with what makes sense with your tax return. But if you actually start as a corporation and then you have to choose either S corporation or C corporation, which are very different tax structures. So it is very common that once a real estate professional, especially a realtor, if they start making more than about $30,000, $40,000 in profit a year, they can actually significantly decrease some of their taxes by becoming incorporated as LLC and choosing an S Corp election. One of the main savings they get is in their taxable payroll, their employment taxes, which is about 15% of your income. Now imagine you're already paying, 32% income to the federal government. And if you have the privilege of living in California, you've got about another 8% you're paying to the state of California. So we pay another 15% for employment taxes. So once you get to about that 55% tax bracket and you're making sure that you're giving the government at least half of the additional dollars that you're making, you might say, well, you know what, maybe enough's enough. How can I lower that? So when you talk to your CPA, we'll be looking at different deductions that we can take. And one thing we can do is we can usually eliminate about half of that 15% on the employment taxes. You can get that down to about 7.5% by categorizing some of your income as subject to payroll. And then another thing is we can usually find additional deductions, maybe up to about 20% that you might be overlooking to bring that tax rate down. So just so you don't feel bad, maybe we can bring it down from 55% to 35 or 40%. So you still feel good like you're doing your fair share.
Follow, message us, or scan the QR code on the screen to learn more.